Hello and welcome to the Wealth Management Invest podcast. Happy New Year. This is our first episode of 2026. I'm excited to bring on Anya Coverman, the president and CEO of the Institute for Portfolio Alternatives. Welcome to the podcast.
Hi, David. Happy 2026 as well. Thank you so much for being here. I'm always so excited to kick off a new year with all of the exciting things going on in alternatives in the private markets.
So before, I've got some questions I want to shoot at you, but before I do that, why don't we just, if you could tell folks maybe who aren't familiar with the Institute for Portfolio Alternatives, what it does and, what your role with it means.
Yeah, absolutely. So the IPA, I'll use our shorthand version. We are a trade association. We have been around for 40 years, over 40 years now, really. Our mission, what's in our DNA, is essentially democratizing investor access to alternatives, private market investments. We really represent the entire alternatives ecosystem. So from global asset managers to industry partners, third parties that are servicing the alternatives business, as well as distribution partners spanning, large wirehouses to registered investment advisors. And really, the way we think about this is our goal is to make sure that individual and institutional investors are on equal footing in their access to diversified, non-correlated assets that have essentially driven more than $1 trillion in capital formation. So as an association, what we do is we, of course, do significant policy work and advocacy, a lot of education. That's a big keyword, which we may talk a little bit more about, networking, and really just involvement and understanding of for our members of what's going on in the private markets today and how do we really create a better operating and business environment for not only firms, but also the underlying investors. And our footprint today is really a global footprint.
You guys have a very interesting perspective then, given, I think there's this conversation that's been happening for the last, couple of years within the wealth channel, very pronounced about the democratization of alternatives. And there's been a tremendous amount of innovation with fund structures and new players entering the space. But you have a much longer time view horizon of the use of these products. So I just wanted to get your thoughts on, having been involved in alternative investments for a longer time, what you make of this past couple of years and some of the stuff that we've been seeing happening.
Yes, I love the way you frame that question, because you are right that the scale, the volume, the innovation, the players is high and evolving. Let me start with a real threshold point, which is that, and I always say this because it's important, alternatives is a really big word.
Right.
And it, real estate, credit, private equity, infrastructure, venture capital, there's a lot that's, encompassed in this word of alternatives. And the conversation that we're having today is really about the access point and opportunities for individuals as opposed to institutional investors having real concrete ability to invest in all of these different types of alternative products. And I've been around in this space for a long time, and we can talk about a lot of trends because you and I talked about maybe 2 years ago, I have probably another view on that today. But I will say that just at a threshold level, what is alternatives? That itself even is evolving, because today we're talking about sports investing, secondaries, new tax efficient structures around life insurance and variable annuities that are driving the conversation. Digital assets, digital currency, technology are a big part of the conversation. Artificial intelligence and data centers. And then even real sort of differentiated niche infrastructure deals and real estate deals. And it all really boils down to this concept that you can take a semi-liquid product and really morph it into just about anything. So it is just an inflection point from a development and innovation standpoint, to reaching the individual investors time in the market. And the questions from investors and their financial advisors, those are real, those questions have really grown and are much more educated than they were before. And I guess the one other point to make, which I would have said this 5 years ago, and then I'll continue to say it, is the reason we're talking about individual access is if you look at institutional access, foundations, endowments have had 50% of their allocation to alts, and individual retail investor, I don't love the word retail, it's really individual investor
Hmm.
access is 1 to 2%, but it really, that's the biggest risk is underinvestment. And if retail channels are like 60 to 70% of global AUM, even by 2030, this is an important conversation. And we also layer in the fact that there's this, large demographic and generational wealth transfer, and trillions of dollars in assets are going to the next generation. So this is timely, and it's really moving the conversation about scale and players and investor questions forward.
Yeah, it's been really interesting to see I think even in this past year, there's been continued, kind of brand names, that folks will have seen that just weren't that accessible before,
Mm.
but now are because of some of these different product types or ways things are being packaged. And then I feel like we've also seen a lot of the tech infrastructure for the wealth space itself is rapidly evolving too. So where you have some of these traditional platforms that where folks are used to using and managing their traditional investments, suddenly creating either integrations with third-party alts platforms or adding that functionality themselves to kind of create this tech infrastructure to allow the advisors to be able to be armed to manage these kind of investments. Is that is that how you see things as well?
Oh, 100%. So you started with the point that you've got these sort of major, non-traditional alts or major sort of traditional institutional asset managers that are
Hmm.
coming to the alts and private wealth space. And they're, names with legacy managers, really core expertise, or whether it's around credit or around real estate. And there's a lot of discussion around the hedge funds and managers that were focused on real liquid products and ETFs that are really trying to say, we need to make sure we're talking to the entire investor landscape, right? Not just the institutional. And frankly, maybe there's also institutional design and structuring principles that are new and interesting and should be adopted and thought about for the wealth channel. And within that, you also have a lot of these sort of public private partnerships,
Hmm.
right?
Hmm.
You're looking to grow your private business, grow your public business. And so firms are combining, rather than sort of what we saw maybe 10 years ago, which is more just, your typical sort of M&A activity and acquisitions. Now there's a lot of, well-known names, well-known brands, and they're saying, how do we come together? And I could name them out, but every major manager in the space probably has some form of partnership that they have, come to the market with or are working with. That's really exciting. Also around the partnerships, and then I'll get to the fintech side of it.
Hmm.
You're also seeing partnerships that are innovating specifically in the 401k
Yep.
defined contribution space, right? So, and that's even a different layer. That is even a different layer of how we think about private markets, innovation, and bringing more opportunities to those investors that where are we at? 65% of investors have your assets in your 401k plan versus maybe it was 30% back in 1980. So those partnerships are really interesting too. And so the conversation around real institutional traditional players coming into the space, public private partnerships, lessons we can learn from the institutional side over to the retail side is really what's driving the conversation. And then to your point about fintech platforms, that is a really interesting innovation. And that's also something we see on a global level. There are so
Hmm.
many, fintech platforms because as you scale so quickly, you really need the infrastructure to support that scale. And the different platforms are lowering, excuse me, barriers to entry. They're improving efficiency. They're helping to appeal to the investor base that are asking questions about, how do I access and learn about private markets? So, and really that's interesting because there's also partnerships happening within the fintech space, right? With
Hmm.
managers, many of the wirehouses, our major banks have done some real partnerships. And it's really, now the newer questions are wherever you're sitting in the alts ecosystem, like how are we innovating to garner market share? How are we answering questions about having the right plumbing and infrastructure? And how are we adopting all these new changes around like even artificial intelligence that are making the conversation more dynamic, but also more complex?
Yeah, it's definitely been a big year for the words joint venture and partner. I can tell you from
Yeah.
my seat as an editor and the press releases I'm getting and the kind of stories I'm writing. So I definitely feel what you're saying on that. Um, so the other piece of this that I'm interested, just given IPA's mission is the regulatory legislative front, because there's that piece of things, and there was the executive order around 401ks around asking the departments to provide some guidance. There's been some talk around the accreditor investor definition. So what's happening on the regulatory front? What are some of the important issues that you're looking at?
Yeah, I'm glad you pivoted because that's important. It's a big part of what we do at the IPA. We live in a pretty complex, heavily regulated space, and that's a good thing. But with that comes, really looking at how I'll say, I always say that good regulation is a reflection of how products are actually used in portfolios and not only how they maybe exist on paper. So there certainly has been a lot of movement and change in this last year, and there's a lot that we're looking at and thinking about for going into this year into 2026. You hit on a couple key points. So, ERISA. We can start with retirement because I know
Hmm.
it's top of mind for everyone. ERISA is about 50 years old now. And it's really time to modernize. And you want to make ERISA work for the next 50 years. I mentioned earlier that most people have their money in for retirement in defined contribution plans, no longer in defined benefit plans. So the executive order that came out earlier this year gave the Department of Labor 180 days to make progress. We know that the department is moving swiftly toward an early February release of rulemaking. And as part of that executive order, there was also discussion about litigation risk. And so, where the department goes in addition to rulemaking and whether they look at, options around amicus briefs this year will be really important. But certainly as an association, we have engaged with the department, but we plan to engage a lot more once we see a rulemaking proposal come out and can comment and have discussions with the department. I would just say that the biggest thing we think about and is on our minds this year is that durability of any rulemaking. The fact that you do see rulemakings shift and change and be pulled back and then come forward in different administrations. You just really want, there's a lot of stakeholders in the 401k space, and you really want whatever rulemaking and changes that happened and to be durable, whether we see a safe harbor or we see some changes around this sort of fiduciary concepts. But again, it's just really, can we have something that lives for the long term and that really catches the US up to what's happening outside the US, the UK and Australia have made a lot more progress around making sure, 401k plans have, outperform the way your traditional defined benefit plans do. So that's a big topic. The accredited investor, you also mentioned that. We know that the SEC has on their rulemaking agenda right now slated for April. So we'll see what comes out. But um, they have sort of an exempt capital formation, exempt offering framework changes, which this accredited investor sort of falls within that framework. And, Atkins has said previously that, he had concerns about over reliance on just pure financial thresholds. Like wealth alone doesn't always equate to your investment sophistication. So, the Invest Act passed the House of Representatives. That had some positive changes that we've seen in the last 6 Congresses around the accredited investor definition, bipartisan changes. So we do hope certainly that the SEC moves some proposals forward, that Congress and the Senate now moves a capital formation bill forward, which they really do need to think about early in the year. But ultimately, wealth alone, net worth alone doesn't tell you whether someone is sophisticated, can understand the risk. And so we supported changes where there's an examination, there's more job experience to qualify. We do believe that the test or the qualifications should be moved forward even more, such as working with a registered financial intermediary. But we'll see what's to come. It's definitely top of mind for many of our members in the IPA. We did this year see several important changes coming from the SEC in the 40 Act space. Multi-share class relief for BDCs, the 15% limitation for closed-end funds, some co-investment relief. We've got some more, this can get a little more wonky and technical, but we have some more work on the horizon. But, we work with FINRA, which has put out some great guidance this year, the SEC, Congress, of course, the Department of Labor, the IRS in many cases. And so it's been a very active year, but I absolutely expect that 2026 in many ways might be even more active. The government shutdown obviously caused activity on the policy front, right? So now that we're past that and we're moving into this year, I think that this is going to be a very active year policy-wise. Certainly, pre-midterms, you see a lot more movement.
And are there any other issues besides those that you have as real priorities?
I would say the last thing that's top of mind is we do have an ongoing concern about regulatory overreach in some states, and that's really discouraging asset managers from registering public non-traded REITs as SEC registered reporting companies and really encouraging them to reconsider that path forward and register as a private placement instead. But similarly, putting the same disclosures and transparency and reporting obligations into their offering documents. But that's really being driven, again, by some state regulations that are just overstepping boundaries, making it very difficult, very costly, and very timely to get an offering, registered and across the finish line. So where it may take, a matter of a couple months to move through the SEC registration process, you could be spending up to a year with a lot of uncertainty of whether and when you will finish going through almost the same process with state regulators. So it's definitely top of mind. We're thinking very deeply about whether there are national ways to address this. Our ultimate goal is that we want to encourage managers to make the right decisions for their business, and if that decision is to have a SEC registered public reporting company, and the gold standard, right, under the SEC framework, then we want to encourage that. So, and we don't want decisions to be made to move to a different structure or a different process just because blue sky laws are outdated and difficult, and you sort of can't get an offering across the finish line.
So one thing that strikes me just hearing you talk about all of these things is that I feel like there's sometimes this notion that, especially like within the wealth channel, as you know, you talked about the fact that, you know, it's well known that the allocations are pretty low when you compare it to other types of like defined benefit plans or institutional investors. So that's kind of a point that people talk about a lot. And I think there's this sometimes this notion that like privates are like super risky or like you don't know you're going to get into. But what I'm left with hearing a lot of this discussion is that there's actually very robust regulatory framework already. There's a lot of consideration put into these things. This is not something that is being done in a very careless fashion. Like the way that it seems to me like the way these things are being designed has a lot of intentionality to it. There's a lot of thought into there's a lot of oversight. So like that piece of that seems overblown to me. And the other thing that I think about with that point is that retirement is this risky place that shouldn't have, 401ks that would be risky to add. But I almost think about it the other way, which is that by moving from defined benefit to 401ks, we lost something because we used to have, if I had a traditional pension, I would have access to all these things, and 401ks have been left without them. So it's I don't know, it just strikes me that there's maybe some misconceptions about all of this that become that you can be disabused of when you actually really hear about all the work that you've done and hear about all of these things that already exist.
Yeah, you said a lot of really important things, which is that, the risk here, look, there's risk in any type
Right.
of investment. Risk is being structurally underallocated to private markets, and that's really often overlooked. And again, defined benefit plans, which is just a great use case or test case, have been traditionally invested up to 40-50% in the private markets, and they've significantly outperformed, the defined contribution plans, which really are not very underallocated, really not invested very heavily in the private markets. And so we want to make sure people are prepared for a secure retirement. And I would also agree with what you said about private placements. These are, respected, large legacy asset managers, that institutional asset managers that are making decisions to have a private placement offering as opposed to maybe a publicly registered offering. When it comes to a REIT or BDCs, we were, many of them are also doing 3C7s and 40 Act programs as well. But some when they do private placements, they're setting them up with the disclosures and transparency and again, robust prospectus as you would have in any other publicly registered product. But they're making those decisions because it is quicker to come to market. It is, the ease of implementation makes more sense when you're trying to make sure you're getting access and opportunities in front of individual investors at a time when they are so significantly underallocated. So, maybe a couple things to consider for your audience as they think about really where the real risk is. And for us, it's just, underinvestment and making sure we do have our investors, whether they're aging investors or the new generation of investors that are having money transfer them, that they are appropriately allocated based on their time horizon, based on their, portfolio and their, risk assessment, assets across the spectrum.
So last thing I wanted to ask you about is, I think you referenced earlier that another thing that IPA is focused on is education and networking. So can you talk a bit about what that looks like, what kind of events you have, and what some of the education that you offer?
Absolutely. So what I'm proud of at the IPA is that we represent everyone in the whole spectrum of, alternatives and private markets. So we're not just focused on one side of the market. And so, we have 4 different events every year maybe 5 in the future. We have 3 here in the US. We've got one coming up at the beginning of February called IPA Wealth, very appropriately named. We've got another event at the end of April here in Washington, D.C., IPA Summit. And we also have a third event here in the US, IPA Vision. This year it's always mid-September, and this year it's in Atlanta. And then we are in London for Alts Global, our Alts Global series in November. And we spend a significant amount of time really thinking about the most important and future topics that our members need to be thinking about and hearing about and socializing amongst themselves. Our events are not marketing events. It's not a pay-to-play type of organization. We invest a great deal of time making sure that when you come to one of our events, whether you are an allocator or distributor or LP, whether you're an asset manager, whether you're a third-party platform or fintech firm or wherever you may sit, you are going to be networking amongst senior leaders and your peers. You are going to be learning, and you're going to be having conversations around the most, latest breaking topics that are driving the industry that we will all be thinking about 12 months from now. We're going to be talking about it 12 months earlier. So I really encourage anyone that's a listener to come and join us. We really do host fantastic events where you will get a much broader depth of what's happening in the private markets amongst our group and our membership.
Well, I think it seems like a pretty good place to end. I appreciate you taking the time to answer my questions and explaining some of the nuances and all of these issues and products and everything that's been happening. I find it all very fascinating. For folks that want to learn more, where can they go?
Absolutely. So please go to our website. It is very easy to navigate. And for the IPA Wealth event in February, you can look at our agenda online. You can register online. We do not, if you are a distribution player, so an RIA, broker-dealer, bank, there is no cost to register. For everyone else, there is, and at a much lower cost if you are a member of the IPA. And for all other topics, our advocacy, our committee work, just what we're doing and what we're talking about in the market, please do look at us online. We have a LinkedIn channel as well, which we're very active on. We also have a YouTube channel, and we have a great team. So I would always say to people, reach out to someone on our team. We are really engaged with our members. We love good conversations, whether you are a member or not a member and want to find out a little bit more about the IPA and what we could do for you to help you learn and grow, ask the right questions, meet the right people in our space.
Well, it sounds like it's going to be an exciting year for your association. A lot of great stuff in the works. I appreciate talking to you. Thank you again for your time.
Great. Thank you so much for having me.
You can find me on LinkedIn, ping me there, as well as for all of our ongoing investment coverage, please go to wealthmanagement.com and look at the investment section where we are covering a lot of these issues on a regular basis, along with coverage of ETFs, model portfolios, SMAs, and all the tools that advisors are using for modern portfolio construction.